Good day, traders. Welcome. This is the ECB rundown then for the meeting on the 7th of March. Summary expectations, no cut expected today. We do also get the staff macroeconomic forecast, and there'll be a lot of attention, particularly on how they describe the current inflation backdrop. Now, in terms of current market pricing, obviously there's no expectation or marginal expectation is 1 basis point of cuts priced into today. If we move forward to the April meeting, there's only 5 basis points of cuts. And the first real sort of emphasis of a cut lands in June. So there's currently around 22 basis points of cuts priced into June. And that's generally where the consensus is that the ECB will begin the cutting process. So there is no expectation today that April meeting is a live meeting, and that's important to understand because that's potentially where a dovish opportunity could be. Now, note in June we do get the new updated staff macroeconomic forecasts. Hence, that's why the market is leaning on this idea that June is probably when the ECB will begin the process of cutting rates. Also, keep in mind the ECB does typically like to cut in tandem with the Fed, simply because you don't want to be the first central bank cutting in case your exchange rate gets hit, because that will then import inflation ultimately. Okay, so by and large, that's the market's thinking, is that the first cut does come in June 22. And very much in terms of a summary, where the ECB's thinking is right now, it's very simple. It comes down to 5 factors. Number 1, growth risks are tilted to the downside, and the ECB expects that near-term weakness will continue. Okay, so very, very important. What will force the ECB to cut rates sooner is if they thought that, yes, growth risks are tilted to the downside, and that they expect this near-term weakness to become something more longer dated, sort of ingrained in the medium term. That will then force them to do what they call an insurance cut, where rather than waiting, they decide to cut sooner rather than later. So right now, we will get obviously updated forecasts on growth. Listen carefully how they characterize that near-term weakness. Has that dissipated, or are they expecting that to now become a little bit more embedded, in which case they're probably going to turn quite dovish. Next up then is geopolitical risks. Okay, this was inserted into the January Q&A, and the ECB characterized the current geopolitical risks with regards to obviously the what was going on in the Red Sea and firing missiles at some of the container ships. But they noted this in the statement, and they said that it can lead to upside prints, in particular in inflation. So there was concerns that in the near term, the geopolitical risks could cause a bit of a spike in inflation. So again, listen carefully how they characterize that today. There's been obviously a good, sort of 6 weeks now since that incident. And by and large, what we're seeing is that there's no real follow through on inflationary risks. So if they do come out and say, those geopolitical risks are now no longer a concern, again, that will be very taken as very dovish from the ECB side. Also keep in mind then, they also say that the inflation target is expected to reach in 2025. And today they expect from the staff macroeconomic forecasts a print of 2.7% for 2024. And this is really where the attention is going to go. This is what the market's going to lean on, is what does the ECB staff macroeconomic forecast think of inflation for this year? Okay, has it come down from that 2.7% that they told us in December? If it does, again, what it means is that the ECB is going to reach that 2% target, perhaps even, as soon as late 24, early 2025. So again, the market will look very closely at when they think they're going to reach that target, because what that means is if they reach that target sooner, it means they can afford to cut sooner than perhaps June. Then note, a key thing that the ECB has told us that is holding them back from beginning the cutting cycle is about wage growth. Okay, there is some concern from the ECB that wage growth demands are still quite high, and that there are potential second round effects. They're not seeing those second round effects, but at the moment they're a little bit concerned that wage growth in Europe is still too high, and it's going to lead to stickiness within inflation. So they want to see more data. They've told us that explicitly. They're just not confident yet. They want to be more confident, and they're very closely watching, in particular, what the wage tracker is doing. That's what they've told us. That's the last thing, in essence, that's holding them back from beginning this cutting cycle. So again, listen how that's characterized, because she's going to get prepped in the Q&A a number of times about how is the ECB assessing the current wage growth. Are they growing more confident? And do they think they'll reach that level of confidence perhaps sooner than that June meeting. So listen very carefully how she characterizes wage growth. And then finally, she told us in January, it is premature to talk about rate cuts in January, and that is the consensus. In other words, the majority on the ECB board think it's premature to begin talking about rate cuts. Now again, she's going to be asked, Madame Lagarde, do you still think it's premature? Or is the consensus that it's still premature? Listen how she answers that, because if she says, no, rate cuts were discussed today, well, then again, that doesn't necessarily mean that we're going to get a rate cut in April, but the market pricing is only 5 basis points in April. So the market will take that as dovish. It'll push in perhaps another 5 to 10 additional basis points into that April meeting and make April perhaps a 50-50 type meeting. Okay, so keep an eye on that particular comment when she is asked on that in the Q&A. Now, in terms of the statement opportunities, there's 4 opportunities to focus on. Firstly, like I said, what is the staff forecast for inflation in 2024? Like I said, they told us in December they expect 2.7% average inflation for 24. Do they lower that? If they do, market is going to take that as a little bit on the dovish side. Okay. Next one, how soon will they reach that 2%? Okay, currently it's expected to reach 2% in Q2 of 25. If perhaps that moves to early 25 or even 24, the market will take that as extremely dovish. Okay, then 2 statement adjustments. Keep an eye for the last couple of months. They have told us that future decisions will ensure that policy rates will be set at sufficiently restrictive levels for as long as necessary. If they drop that long as necessary, what they're telling us is that they'll keep policy rates at sufficiently restrictive levels, okay? And that means they can begin the process of lowering nominal rates because the real rates will still be quite restrictive. So keep an eye. If they drop that long as necessary, they're leaning on this idea that, we want to start preparing the markets in terms of guidance for the rate cut cycle. Okay. And then finally, also in the statement, if they drop the word maintained for sufficiently long duration, similar to that previous statement adjustment, they've told us in the past that their current assessment is that they consider interest rates are at levels that, if maintained for a sufficiently long duration, will make a substantial contribution to this goal. Okay, they could drop that maintained for a sufficiently long duration. In other words, what they're saying is if they keep interest rates restrictive, that will contribute to their goal of getting back to 2%. Okay, a little bit like the Fed is telling us, or Powell told us yesterday, that they don't need to see inflation at 2%. They just need to see more of the same kind of inflation prints. It's a similar kind of thing where they don't necessarily need to see inflation keep coming down. They just need to, see more of the same, and that means that things are sufficiently restrictive, and they'll get back to that 2% in time. Okay, so that's the statement opportunities. Finally, Q&A. Like I said, a couple of things listen out for. Did you discuss rate cuts today? Yes or no? What is the consensus on the board? Listen out for wage data. Have you grown more confident on the data? And again, listen to how she characterizes that. If she sounds positive, what she's leaning on is that, yes, we're that one step closer to rate cuts. And then finally, like I said, geopolitical risks. Is it a concern? It's probably not. Okay, we've not seen any real pass-through from the geopolitical risks. So again, that also leans on this idea that that near-term risk to inflation has now disappeared, and perhaps we get back to that 2% target ahead of schedule. Okay, finally, in terms of trades, where to look? 2 things, okay? One thing that's very interesting, there's not much volume in the euro. So yes, instinctively traders say, I'm going to trade the euro because that's what they know and that's the only thing they know. The reality is there's not much going on in the currencies. There hasn't been all year. So I think euro is something you trade to the downside simply because we've had quite a lot of buy-side activity, quite a bit of positioning over the last 4 or 5 sessions. So euro, I think if they come out dovish, if, all of a sudden April is now a 50-50 type meeting, yes, I think euro could easily drop 75 to 100 pips. In terms of the upside, again, what are they going to say that's hawkish, that's sufficiently hawkish to suddenly get everyone buying up the euro? I just don't see anything in that line. So for me, it's very much a case of if they dovish, you can sell the euro. However, where there is opportunity, if you've been watching the bonds in particular over the last 4 sessions, you will notice a significant amount of flattening going through US curve, the European curves. The curves are flattening. Okay, so what that means, and this is why bonds are very good to trade today, if all of a sudden they come out a little bit more hawkish. Okay, for whatever reason, perhaps Lagarde comes out a bit more hawkish, says, look, we may only begin the process of talking about rate cuts after the summer, something along those lines. Okay, the curve's going to flatten. So what will happen is the front end will sell off, the back end will follow initially, but then the back end will get absorbed and bid up. Okay, so the flatten is the real key today, because if they were to come out dovish and they were to lean on this idea of perhaps an April cut is a 50-50, ultimately, again, in that instance, the front bonds will ultimately drive up the page. Why? Because they need to price in that rate cut. But because of that flattener, the long bonds will really, really outperform the market. Okay, in other words, a flattener trade is the real opportunity today. Whether it's dovish, whether it's hawkish, the markets just want to keep flattening for whatever reason. Okay, so keep an eye on that. Bonds are definitely the space to be today. In a hawkish environment, yes, they can obviously offer quite nicely. In a dovish environment, they can continue this rally we've had over the last few sessions. Okay, that's the ECB rundown. Good luck out there, and remember, manage your risk.